FuboTV was one of the worst performing stocks in the market in 2024, despite the overall market, the S&P 500 index, rising more than 20% for 2024. Looking back longer, FuboTV stock is down more than 95% off its highs. That has a lot of investors kicking the tires around, asking if now's a good time to buy Fubo stock or if Fubo price is undervalued. Well, I'll answer one of those questions in this video. Specifically, I'll look at a discounted cash flow valuation of Fubo to determine what the intrinsic value per share of this highly volatile sports-centric streaming TV stock should be. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so to make this price estimate, I need several inputs for my model. Three of those inputs are the company's market cap, which stands at 469 million, jumping over 10% today, actually, and the cash and equivalents balance at 146 million, and the total long-term debt of over 340 million. I also need the company's average diluted shares outstanding at 331 million. You can see the company's been diluting shareholders aggressively in recent years, selling more and more stock to fund the losses on the bottom line, which have been extreme. I also need the company's beta, which according to Yahoo Finance, the beta stands at 1.77. Remember, beta measures the risk of the company's share price. It compares movements in the company's stock price versus movements in the S&P 500 index. So a beta of 1.77 means that FuboTV's stock price moves 77% more than the movements of the S&P 500 index in either direction. So when the index rises by 1%, FuboTV stock on average rises by 1.77%. And the same is true on the downside. When the S&P 500 index drops by 1%, FuboTV stock price drops by 1.77%. So it's 77% riskier than the average stock in the S&P 500. And I would argue it should be rated much riskier than that because of the company's performance, because of the losses on the bottom line, the business model, and the way it operates, and the incoming sports streaming services, the increasing sports on other streaming services that are going to hurt the business longer term. So I also need the company's free cash flow estimates for the next several years. And the unfortunate thing about FuboTV and the data that I have available about FuboTV is that there's only one analyst making forecasts for FuboTV free cash flows. So that makes it a lot more unreliable because you're relying on one analyst estimate for free cash flow. Typically, when I'm looking at sources for a company and the free cash flow estimate, I have multiple analysts that are following the company. And so I get a consensus of all of the analysts. And so that brings more diversity. You have some analysts who might be extremely bullish and some analysts that might be extremely bearish. And so when you took a aggregate of the analyst estimate, you get a better idea of what the company's free cash flow could be in future years. For FuboTV, it's only one analyst following the company, according to this data source, which is ticker.com. And that analyst is extremely bullish about FuboTV. I think way too bullish. So this analyst, according to this analyst, he believes that, or I shouldn't say he, but the analyst believes that Fubo will turn free cash flow positive in 2025 after multiple years of negative free cash flow for the company, although it has been improving. The analyst believes that the company will generate positive free cash flow in 2025, and that free cash flow will soar between 2025 and 2028, rising from 130 million in 2026 to 290 million in 2027 to 430 million in 2028. Needless to say again that I believe these forecasts are too optimistic for Fubo that has yet to deliver 1 year of positive free cash flow, and the business model doesn't give me confidence that the company can achieve these levels of improvement in free cash flow. If you're not aware of what FuboTV does, it's a sports-centric streaming service. It's like subscribing to cable and getting a bundle of channels. But instead of doing that with a cable connection, you're doing it with a streaming connection. So you're getting a bundle of TV channels for around $80, $90, $100 per month, depending on your selections. And Fubo TV then pays the owners of that content. And up until this point, FuboTV has not been able to operate that business at a profit or anywhere near a profit because it has to pay so much money for the content providers. And I don't see any reason why the content providers are going to give FuboTV a break or a lower price because they have their own streaming services, right? One of the primary partners for FuboTV is Disney and ESPN, which Disney owns. Disney has its own live TV service. It's a competitor to Fubo in Hulu Live TV. So why would Disney want to give Fubo TV favorable terms for ESPN when it's competing against itself? It doesn't make sense, right? So I have not been confident in Fubo TV, and I've had the stock rated as a sell for several years now. And so these estimates look extremely optimistic to me. So I'm going to adjust them downward. But I wanted to share with you the numbers, the actual number estimates, and then you can see my adjustments. And then you can determine for yourself if I'm being too pessimistic about the company or if my adjustments are right according to these forecasts. All right, so now that we have the inputs, we can go ahead and jump into our model for Fubo TV, our discounted cash flow model, starting with 2024, where the company generated negative free cash flow. That's expected to be positive in 2025 at 10 million. And then I have the cash flow increasing, tripling in 2026 to 30 million. And then I have it increasing by another 50% to 450 million, and then increasing by 25%, or I should say 33%, to 600 million. So I'm also giving Fubo TV credit for generating positive cash flow, and I'm giving them credit for increasing their cash flow between 2025 and 2028 by 6x from 10 million to 60 million. So I'm incorporating the analyst estimate for 2025 for 10 million in free cash flow, and I'm having the free cash flow grow by 6x in those 3 years to 60 million. So I'm still giving them a lot of credit for free cash flow growth, although nowhere near as much credit as the Wall Street analyst that's following Fubo TV. From that point on, I have the company's free cash flow growing at a slower rate at 12.5% during this transition period, and then settling down to a longer term growth rate of 5%. So because these are cash flows expected in the future, we need to discount them back to today. And the weighted average cost of capital I have for Fubo TV is 13.91%. I give them a cost of debt of 13.5%, cost of equity at 15% with the beta at 1.77. The company has $341 million in debt and a market cap of $469 million. So I give them a debt to equity of 75% debt and 25% equity. That's a big risk in and of itself that the company has so much debt compared to its market cap for being such a smaller company. Now, if they start to generate free cash flow at the levels that is forecasted, they still would not be able to pay off this long-term debt. So they would need to refinance this debt at favorable terms. And if they are generating free cash flow, then they can refinance at favorable terms. But if they end up continuing these losses, they might not be able to refinance at favorable terms. Okay, so the value of operations for the company I have at 692 million. When I add the cash balance of 146 and subtract the debt of 341 million, I get a value of equity around 500 million. If I divide the number of shares outstanding, 331 million, it brings me to an intrinsic value per share of $1.50 for Fubo TV compared to the current market price of $1.41. So according to these calculations, the FuboTV stock price at $1.41 suggests that it's roughly fairly valued. I provide myself a larger margin of safety, roughly 10% margin of safety. So when the share price is close to my intrinsic value, by this close, I say it's fairly priced. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.